Stock. A stock is a tiny slice of ownership in a company. When a business needs money to grow, it doesn't always go to the bank. Sometimes it sells pieces of itself to the public. You buy one of those pieces and now you're a shareholder. You own a fraction of that company. If it does well, your slice becomes more valuable. If it collapses, so does your investment. Stocks aren't loans. You're not lending money. You're buying in, which means you share the wins and the losses. There's no guaranteed return. Just the bet that the company you chose will be worth more tomorrow than it is today. Stock exchange. A stock exchange is the marketplace where stocks are bought and sold. Think of it like a farmer's market, except instead of tomatoes, people are trading ownership in companies. The New York Stock Exchange and the NASDAQ are the two biggest in America. Every time you buy a share of Apple or Tesla, that transaction flows through one of these exchanges. They set the rules, track prices, and make sure trades actually happen. Before exchanges existed, buying stock was chaotic. People traded in coffee shops with no system and no oversight. Exchanges brought order. Now, millions of trades happen every second, all logged, all tracked. Portfolio. A portfolio is the full collection of investments you own. Stocks, bonds, real estate, ETFs, cash. Everything you've put money into is inside your portfolio. The word sounds fancy, but it just means your financial holdings, the complete picture of where your money is working. The whole point is diversification. Put everything into one stock and that company collapses. You lose everything. Spread across 20 investments and one failure barely moves the needle. Professional investors obsess over balance. How much in stocks versus bonds? How much risk you're actually carrying? For most people, a portfolio is either something they're actively building or something they're ignoring. The ones building it almost always end up ahead. Dividend. A dividend is a cash payment a company sends to its shareholders just for owning the stock. Not every company does it. Growth companies like Amazon usually reinvest profits back into the business. But older established companies, think Coca-Cola or Johnson & Johnson, regularly hand a portion of profits directly to investors. Own 100 shares and the company pays a $1 dividend per share, you get $100 in your account. You didn't sell anything. You just owned the stock. Dividends are why some investors specifically chase certain stocks. It's passive income built into the investment. Reinvest those dividends automatically and you're compounding returns without lifting a finger. Market cap. Market cap, short for market capitalization, is the total value of a company according to the stock market. The math is simple. Take the current stock price and multiply it by the total number of shares in existence. A company trading at $50 a share with 10 million shares that are outstanding has a market cap of $500 million. Market cap is how investors size companies up. Large cap companies like Apple or Microsoft with market caps in the trillions are considered stable. Mid-cap companies are growing but riskier. Small cap companies are volatile. Higher risk, higher potential reward. The stock price alone tells you almost nothing. Market cap tells the real story. Bull market. A bull market is when stock prices are rising and investors are optimistic. The name comes from the way a bull attacks, horns driving upward. When the market enters a bull run, confidence is high, money is flowing in, and almost everything goes up. Bull markets aren't just a good week. The technical definition is a rise of 20% or more from a recent low sustained over time. The longest bull market in American history ran from 2009 to 2020, over a decade of nearly uninterrupted growth. During bull markets, people feel rich, spending increases, companies hire, and the cycle feeds itself. The danger is complacency, assuming the good times last forever, because they never do. Bear market. A bear market is the opposite. Prices are falling, fear is spreading, and investors are pulling money out. The bear swipes downward. That's where the name comes from. A drop of 20% or more from a recent high officially qualifies. Bear markets are brutal. People watch their portfolios shrink and panic. The instinct is to sell everything and wait it out. That instinct is almost always wrong. Markets recover. Every bear market in history has ended in a new bull run. The investors who stay calm and ride it out come out ahead. The ones who sell at the bottom lock in losses permanently. Bear markets feel like disasters. In hindsight, they're usually buying opportunities most people were too scared to take. Broker. A broker is the middleman between you and the stock market. You can't call up the New York Stock Exchange and start buying shares. You need someone with access to the exchange, and that's what a broker provides. Today, most brokers are apps. Fidelity, Charles Schwab, Robinhood. You open an account, deposit money, and they execute trades on your behalf. Most charge nothing per trade these days. Traditional brokers charge commissions and came with financial advice attached. That model still exists for wealthy clients. But for the average person, a brokerage account is just an app on your phone. The broker sits invisibly in the background, routing orders, settling trades, and holding your assets. ETF. An ETF, or exchange-traded fund, is a basket of investments packaged into a single product that trades like a regular stock. Instead of picking one company to invest in, you buy a share of an ETF and instantly own a slice of dozens or hundreds of companies at once. The most popular ETFs track indexes like the S&P 500, which holds the 500 largest American companies. Buy one share and your money is spread across Apple, Google, Amazon, and 497 others. Low cost, automatic diversification, zero stock picking required. Before ETFs, building a diversified portfolio required buying individual stocks, which took real money and real knowledge. Now a beginner with $50 can own a piece of the entire American economy in one move. Volatility. Volatility measures how wildly a stock or market swings in price. A stock that moves 1% on a normal day is low volatility. One that swings 10% within hours is extremely volatile. Volatility isn't good or bad. It's a measurement. High volatility means big potential gains, but also big potential losses. Newer companies, speculative stocks, and crypto tend to be highly volatile. Blue-chip companies and government bonds are typically stable. Investors years from needing their money can stomach volatility. Investors who need cash soon can't afford to watch their savings drop 30% overnight. Your timeline determines how much swings you can accept. The mistake most people make is treating volatility as the enemy. It isn't. Panic is. Capital gain/loss. A capital gain is the profit you make when you sell an investment for more than you paid. A capital loss is the opposite. You sell for less. Both matter when tax season arrives. Buy a stock for $1,000 and sell it for $1,500, and you have a $500 capital gain. The government wants a cut. How much it gets depends on how long you held it. Hold for less than a year and it gets taxed like ordinary income. Hold for more than a year and you qualify for long-term capital gains rates, which are significantly lower. Capital losses can offset your gains and shrink your tax bill. Investors use this deliberately, selling losers at year-end to cancel out gains elsewhere. It's called tax loss harvesting, and it saves real money. Liquidity. Liquidity describes how quickly an asset can be converted into cash without losing value. Cash is perfectly liquid. A share of Apple is highly liquid. Sell it in seconds during market hours and the money hits your account the same day. Real estate is illiquid. Selling a house takes months, involves fees, and you might need to drop the price to find a buyer fast. Liquidity matters most in emergencies. If you need money immediately and everything is locked in assets you can't quickly sell, you have a serious problem. That's why cash emergency funds exist. Not because cash earns returns, but because it's available instantly. Illiquid investments often generate higher returns precisely because they lock up your money. The premium exists because easy access has real value, and not everyone can afford to give it up.